Welcome to this very special webinar where we are going to talk about gold and the rise of gold as an asset class and the prices that we have seen. I'm Pavitra Parekh, and with me for this discussion today, I have Sheila Kulkarni, who's joining us. She's the head of investor relations, institutional investor relations at the World Gold Council, as well as Siddharth Srivastava, who heads ETF products for us here at Mirae Asset, and he's also a fund manager for our passive products. So to discuss the big rise that we've seen in gold, let me just put it into context. Gold is now nearing the 90,000 rupees a mark. In the international market, it has hit almost, actually crossed the $3,000 mark as well. So that is a very important level that, caught everyone by surprise and really had all of the investors' interest. So to discuss this big move, what is aiding this big move as well, and how we can look at it from an investor standpoint, I know Sheila has an entire presentation prepared. So Sheila, if we can come to you for that first, and then I have a lot of questions that I'm also going to come to you with for both you and Siddharth, and how we can look at it from here on as an investment. So first, over to you, Sheila.
Thank you. Thanks, Pavitra. I am from the World Gold Council, so I'll give a quick outlook on who we are and what we do. We are a membership-driven organization formed by some of the world's largest gold mining companies, and we help shape the role that gold plays as an asset class. And we also have a team of experts that builds understanding around the use case of gold through trusted research, analysis, and insights. We also drive industry progress by shaping policy across various geographies where gold is consumed, and we set the standards for a perpetual and sustainable gold market. Now, coming to gold, most of us would know that gold is a global market, right? Any continent, any geography that you go, gold is used in some form or the other. Having said that, 71% of demand for gold comes from emerging market economies such as India, China, and Southeast Asia. 29% of this demand comes from the developed economies such as US and Europe. If you look at what drives demand, why are certain economies consuming more, and what actually drives demand in those countries, we've actually divided the demand into two different buckets. One is the strategic demand and the tactical demand. Within strategic, we've seen that economic expansion, periods of growth are very supportive for jewelry, technology, and long-term savings, thus driving demand into these avenues. Risk and uncertainty also plays a big role in the demand for gold. So we've seen this, whether it's geopolitical risks or systemic risks that lead people to move to gold away from other asset classes. So market downturns typically boost, the investment demand for gold as a safe haven. On the tactical side, opportunity cost is something that drives demand. So the price of competing asset classes, whether it's through interest rates and bonds or other assets and currencies, this also influences the demand for gold. And the last is the momentum. So capital flows, positioning, and price trends can ignite or dampen gold's demands. Having said that, gold has a dual nature. It's not just an investment asset, it's also a consumption asset. So this is something that is unusual if you compare it with other commodities. So on an average, we estimate the annual gold demand to be about 3,100 tons, of which obviously jewelry accounts for 33%. We've seen countries like India and China consuming gold through jewelry, and 40% of the demand is through investment. So whether it's bars, coins, or ETFs, that accounts for 40% of the annual demand. 7% of the demand also comes from technology. So if you look at all your laptops, phones, chips that are used for running the servers that go into AI, all of them actually consume gold, and they're made of gold. So that drives, that's where the demand comes from. Now, if you look at Indian demand, it's a little different in the sense that we are one of the world's largest consumers of gold, but our demand comes from various factors and reasons. In the long term, income is a big driver for our demand. So for every 1% increase in income, we've seen that the gold demand actually goes up by 0.9%. We've done an econometric analysis, and we've also seen that price has an effect on gold. So when the price increases by 1%, the demand for gold actually goes down by 0.4%. in the long term. In the short term, again, it's price, but it's also inflation. We've seen that when inflation goes up by 1%, the demand actually goes up by 2.7%. So people start moving money from discretionary spending into gold. Similarly, monsoons play a big role. If you have a good year where monsoons are over the long-term period average higher than 1%, then we've seen demand go up by 0.1%. Reduction in customs and duties also add to the demand for gold by about 1.4%. And if you look at the price of gold in the short term, yes, it does have an effect. So in the short term, the demand actually goes down by 1.2% for every 1% rise in income. Having said that, because gold is an integral part of our culture, whether it's festivals, auspicious days such as Dhanteras and Akshaya Tritiya, we've been consuming gold for centuries. On an average, over the past few years, our demand has been fairly consistent in the range of 750 to 800 tons. Most of it is, of course, jewelry. Central banks have been contributing, the RBI especially, has been contributing to this demand by consistently over the last few years adding gold to its reserves, and investment demand is also picking up, whether it's through bars and coins or gold-backed ETFs. This segment has also seen an uptick. Now, what is the strategic case for gold? What does gold do in a portfolio? Does it actually provide returns? Is it a good diversifier? And does it provide liquidity? Let's take a look. So gold has been a standout performer over multiple time horizons. We've done an analysis over 1 to 15 years, and we've looked at Indian stocks, corporate bonds, government bonds, and other asset classes. And we've seen that gold actually does well, giving on an average returns anywhere in the range of 8 to 12%. If you look at periods of high inflation, again, gold stands out. And if you look at the CPI inflation, which is a better measure of how inflation actually keeps up with money supply growth, we've seen that gold performs well even in periods of low inflation. Is gold really a volatile asset? So yes, if you look at bonds, it is slightly more volatile than bonds. But if you look at other asset classes such as oil, US stocks, Indian stocks, gold is much lesser volatile if you compare it with these asset classes. Now, when it comes to diversification, good diversifiers are really hard to find. Typically, we've seen that gold does well when equities do well. It's obvious because, in periods of economic expansion, when people start earning more, they also start saving more. And whether it's through equities or gold, we've seen this positive correlation. But what's more important is when equities crash or equities don't do so well, gold does better. And therefore, it's important to have gold as a diversifier in your portfolio. We've seen something similar with bonds, where when bonds don't do well, gold does better. So there is a negative correlation. In terms of geopolitical risks, we've done an analysis right from the 90s when we had the Gulf War, the 9/11 bombings, Brexit, and the Russian invasion and Israel-Hamas invasion. We've seen in all these periods, gold actually has done well because the uncertainty in other asset classes goes up. Likewise, in periods of systemic risk, whether again it's the LTCM crisis of the mid-90s, the 9/11 bombings, the sovereign bond crisis, or if you look at the 2018 pullback or COVID, in all these times, the flight to gold has proven that it is a good diversifier. In periods following a systemic sell-off, again, we've seen that gold does well. Gold is also a very liquid asset. If you compare it with various other asset classes, the amount of gold that gets traded on a daily basis is much higher as compared to Indian stocks, bonds, or even some of the other global asset classes. And if you look at 2024, we've seen that gold actually outperformed most asset classes in comparison with even Indian equities. So it on an average gave across currencies more than 20% returns. And in 2025, again, it has outperformed. As Pavitra just mentioned, it has already crossed $3,000 per ounce. And we hope, that the performance continues. What's important to understand is that gold doesn't conform to typical valuations that you would see in equities and in bonds. It's also, in terms of price volatility, it's not very volatile. And therefore, uh, sometimes it doesn't really give you the returns that you expect in periods over short term. But what does it do to a portfolio, and why have gold in a portfolio? We created a hypothetical portfolio with about 45% equities and 55% of debt, and we progressively added gold ranging from 5% going up to 15%. And what we saw was that risk adjusted returns in a portfolio with gold were much higher. So gold actually improves the risk adjusted returns. It reduces volatility, and the reward to risk by having gold in a portfolio is much higher, as well as the drawdowns are much lower. So, if you add 7.5% gold going up to 15%, the annualized returns can go up by 11.6%. Volatility definitely goes down, but the reward to risk is 101% if you have about 15% of gold in a portfolio. How do you invest? I think it's important for investors to understand what is it that they need the gold for, what is the size of the investment, and how frequently will you be rebalancing your portfolios. Would you need physical delivery? Do you need to touch and feel the gold, in which case you have bars and coins? You also have gold-backed products such as ETFs, which are regulated today, and you have vaulted gold. Now, if you look at India alone, gold-backed ETFs are a popular asset class. They've been growing significantly since 2020. Last year alone, we saw inflows of up to 54 tons in gold. And this year, we have seen again progressively inflows in gold ETFs going up to 66 tons in all the 20 ETFs that are listed today in the market. If you look at supply and demand trends, gold, like I said, annually has a demand of about 3,000 tons. But if you look at 2024, it was a good year for gold. Demand went up by 1% to 4,900 tons. And gold ETFs actually contributed significantly, especially in India. Central banks also continuously were buyers, leading to over 1,000 tons in demand. India alone, RBI bought about 72 tons last year. And if you look at bar and coin demand, that was more or less in line with the 2023 demand at about 1,186 tons. Jewelry demand, on the other hand, was a bit lower. Even the Indian jewelry demand was less by about 2%. Technology demand, on the other hand, has seen a 7% year-on-year growth, driven by, like I mentioned earlier, the servers that go into running of AI and the chips that are used for these servers, which have gold. Supply also rose to an all-time high of about 4,974 tons. LBMA price, this is up to Jan. We've seen there's a steady increase since 2022. And if you look at the recent surge, like I mentioned, gold has crossed $3,000 in record time. And it's one of those reasons where we see, the demand for gold as a safe haven asset, as an insurance for your portfolio, as an alternate to the dollar going up. If you look at the outlook and the performance, we expect investment, geopolitics and slowdown concerns as a plus for bar and coin. Of course, we'll need to see how tariff wars pan out, the political transition because of Trump and also China stimulus will present some down risk. But if you look at fabrication demand, it could be challenged. Fabrication is jewelry. It could be challenged by the prices, and unless prices pare back, we also think that central banks will continue to buy, but not probably at the same pace as they have been buying for the last 2 years. Supply, which is through mines, is constant, but recycling would obviously respond to price, because what people do then is exchange old jewelry for new, and near market supplies are not really there through additional mining. So that is the end of my short presentation, Pavitra, and we can take some questions.
All right, Sheila, thanks a lot. That, really helps to set the context and tell us some of the key reasons why we've seen this big rise come through in the price of gold. I have a bunch of questions that I'm going to come to you with on what we could see from here on. What are the factors that could, lead to some impact on this move? But Siddharth, let me come to you also as an AMC. The question that we get the most is, okay, fine, it has run up a lot, but is gold still good for more? If I'm an investor, if I haven't gotten in and someone is asking this question, then do you think gold is good for more?
Yeah, so let's recap. In last 1 year, gold has given almost 34.7% return if you're looking at MCX spot levels, right? In this year till date only, it has run up 16%. And that, especially against the scenario which we are seeing in equity markets, if you remove past 5, 6 days, we have been seeing significant weakness in equity market. And that's why the focus on gold and silver also has been huge, right? Because these two commodities have given significant returns, whereas Nifty has been negative by almost 12-13% from its 52-week high. Now, gold has run up quite quickly, right? I think there's a report by World Gold Council which says that last $500 from 2,500 to 3,000, gold has covered in just 210 days. That has been the fastest. Previous 500 increments were, I think, roughly around 1,700 days, if I'm not wrong.
Yeah, that's right.
So this run up is quite quick, very fast. And probably that is why we should expect some consolidation also to happen in gold. So price to consolidate a bit, probably correct a bit, and then what will happen? Let's talk about that, right? So right now, if you're looking at data, there are several tailwinds which are supporting gold price, right? It's not just that because of turmoils in the stock market, we are seeing rally in gold because people rush to safe haven asset. First is central bank buying, which is helping gold a lot. In last 3 years, every calendar year, central banks have bought more than 1,000 ton every calendar year. That is probably the first time. It's a hat trick, right? The major buyers being China, Turkey, Poland, India. What has also aided the gold recently is obviously the fact that this entire geopolitical escalation, the tariff wars, which have been sorts of, we're discussing about it since Trump came into power, and then also the recent Fed policy, which talks about that US growth will not be as strong as expected earlier. This inflation may be more sticky, may persist because of all these tariff issues. So there are several reasons, and I think personally, I feel that central bank buying is probably one of the strongest reason why we are seeing a very strong demand from gold all across. And Sheila has already covered that that demand from ETFs globally has been also very strong, not just in India, but in North America and Europe also. So yes, I think 3,000 plus levels, it's good to see the gold run up. But I'll probably, while I'm bullish for gold in the long term, I believe that gold should be there in part of everyone's portfolio, and there should be a decent allocation. But I'll sorts of cautious against the recent euphoric rise and say that there might be some consolidation and people should invest from a long-term point of view, right? Like Sheila mentioned that lower correlation with equity is something which creates a very good return and risk profile for your overall portfolio.
And also the kind of portfolio that Sheila was just mentioning, that when you start adding gold, what it can do to your portfolio over a longer term is, I think, what we should all be focusing on. But thanks for that, Siddharth. Sheila, coming back to you now, gold is considered that ultimate safe haven asset, right? That when there's so much uncertainty, you just buy gold and you'll likely do better. we've spoken about some of the reasons that led to the rise of gold prices. But from here on, what are the key factors that could affect the price move? Now, whether that's on the upside or on the downside, or it leads to a consolidation, what are the key events or factors that I should watch as an investor if I, want to know that these are the things that could maybe kind of lead to some impact?
That's a good question. And in fact, I'll add to what Siddharth said. Basically, whether it's geopolitical issues, whether the war escalates in both the countries, Russia, Ukraine, or Israel, Hamas, that would be one factor. Tariffs will play a big factor in terms of, how, globalization actually changes and becomes more localized. And also, what would impact is interest rates by various central banks globally. Having said that, mine production is more or less constant. But on the other hand, we are also seeing technology demand go up. And that could be a contributor to how, demand actually impacts, the price. Besides that, markets like India, we are seeing jewelry demand actually come down. Last year alone, there was a drop by 2%. But on the other hand, that demand is being taken up by investment. So gold-backed ETFs have actually grown consistently month on month almost last year, and we're seeing the same trend this year. So the financial literacy, as that improves, as people have, more access to equity markets, whether it's through increased demat accounts or through mutual funds, all of that will also contribute to investment demand. And last but not the least is central bank buying. Again, Siddharth has already alluded to it. RBI alone, like I mentioned in my presentation, bought 72 tons last year, but this year was also about 2.8 tons in January. So we'll have to see how, the rest of the year pans out. But these are the various factors which would impact gold.
Okay, got that. So we're going to keep an eye out on all of these factors. Sheila, very interestingly, you mentioned that the demand for jewelry, for example, is coming down because while you see the price charts of gold and it's very easy to go and buy an ETF at that point, you may not want to buy a gold necklace at those kind of gold prices as well. I know we're coming out of the November to Feb kind of wedding season and the jewelry demand was not very strong. Do you see that changing in the next wedding season, which comes through in May, or do you think it's going to take a little bit longer to recover?
See, what happens is, again, the Indian market behaves a little differently, right? There is a short-term impact for when the prices rise, and there is a long-term impact. Having said that, when we've seen that when prices stabilize, people still come back in. So, people last year we saw, for example, until June, people holding back onto their purchases because they thought the prices would stabilize or come down. And fortunately, the reduction in customs duties and taxes turned out to be a positive for gold. If people immediately bought on dips. We could see that happening this year as well. Plus, let's not forget, when an economy expands, when there is economic expansion, wages rise and people like to park some money in gold. And whether this is through jewelry, it's likely to happen. It's not just weddings. You also have Akshaya Tritiya coming up. You have Dhanteras during Diwali. All these factors, people do buy gold. And we will not see a sudden dip in jewelry demand. People will buy. They might reduce their budgets a bit given where the price is. But I don't think the purchases of jewelry are going to change drastically because none of our weddings are complete without jewelry.
Oh, absolutely. We are a country that has historically always loved gold, and I don't think that is going to change, like Sheila mentioned. But Siddharth, let's talk about your favorite topic now, which is gold ETFs. And while demand for jewelry might have come down a bit, there is no stopping the demand for gold ETFs. We've seen so many, people participate. And of course, large corporations and institutions like to hold gold, but even retail participation is so strong. So tell us about how that has changed over the past year, but specifically tell us how has it changed in, the last 5 months since October, basically when the market started correcting.
Sure. So right now, after SGB, gold ETF is only regulated investment vehicle which is available, right?
And so liquid.
It's so liquid, right? So it is backed by LBMA certified 1 kg 995 purity bars, and there's a custody, there's a vaulting agent, there's entire guidelines which is placed by SEBI, which regulates how gold ETFs should be managed, and that is very important, right? Because When it comes to gold, people are very protective about it. They're very concerned about the safety and purity and whether they will be able to liquidate it when time comes. And that is all which gold ETF provides. In last 5 to 6 months, we have seen a significant increase in the trading volume of ETFs. So I'll first talk about trading volume and then talk about how inflows have grown. So, for example, gold in past 6 months has traded on an average around 170 crores on a daily basis on both the exchanges. This is total. 3 years back, this volume was only 33 crores. So from 33 crores to 170 crores is the increase in the average daily volume. When we're talking about number of investors, in 2022, they were around 46 lakh. That has increased to almost 64 lakh. That's almost a 26% CAGR growth in terms of number of investors. And like you're mentioning, retail also has increased from 45 lakh to almost 62 lakh. So the folios have also increased in last couple of years, and so has the trading. Also, one very sorts of interesting thing in terms of inflows also has been that not only gold but silver has also seen reasonable inflows. So gold right now the AUM is roughly around 55,000 crores. Silver is around 14,000 crores. But in last 6 months, gold has seen inflows of around 11,000 crores and silver around 3.3 thousand crores. So when we are seeing bit of a flattish inflows on the equity side, gold and silver has been a silver lining on the passive side of things, at least, especially gold ETF, silver ETF doing really well. What also helps is that for investors who don't know, there are gold FOF and silver FOF also. So if you're not comfortable with buying and selling on the exchange, you can simply do SIP, STPs, etc., using a simple mutual fund route, which is the gold fund of fund. I won't take much time because we have been talking about gold performance a lot, right? And especially when you talk about point-to-point performance, it reeks of recency bias, right? So what I've done is talk about SIP returns which gold has given, right? So last time when gold hit $2,000, that is also when we talked about gold a lot. If you would have invested then, which seemed peak at that point in time, your SIP, monthly SIP would have generated almost 19% XIRR compared to 11.2% by Nifty 50, right? Even a 10-year SIP would have generated a 15% XIRR versus a 13.1% by Nifty 50. So right now, investment in gold commodity from a long-term point of view makes a lot of sense, especially from overall portfolio risk return profile point of view.
Okay, got it. That's very, very interesting to hear all of those numbers. I, of course, know that it's gone up, but to hear that larger number is definitely quite something. Sheila, let me come to you now. You know, one thing that we always talk about with gold is that it is a more stable asset class, right? Whether you compare it to equities. Now, the thing is that, of course, we've seen a big run up, and it is always hard to invest when there is a big run up. But also the crashes in gold are rarely as severe as in equity, right? When the equity market goes up very high, there's a chance of it crashing big time as well. Do you think that is something that should provide some kind of comfort to anyone looking at gold, that the crash is usually not so significant? And of course, it might stay sideways for a while and it might come down a bit, but it won't behave like equity in that sense?
Absolutely. What you're saying is really, apt in the sense that what one needs to remember is that gold is not as volatile as equities. And the other aspect is that it is also a very liquid asset. So in my presentation, I showed the amount of gold that gets traded on a daily basis. Plus, if you want a diversifier, today there is no better diversifier than gold in a portfolio. So from that, all these three perspectives, whether it's returns, liquidity, and volatility and diversification, gold actually fits in perfectly. And if you look at the hypothetical portfolio that I showed, again we've seen that with and without gold, portfolios with gold definitely do better. So I think that is one thing to remember, that whilst equities may go up and go up fast. When they crash, the only asset class that can balance and provide that cushion from a hard fall or a hard landing is gold.
Okay, got that. And you've actually led me straight to my next question, because you spoke about a portfolio that has gold in it as well, along with equities. Of course, Siddharth was talking about gold ETFs, gold FOFs. Gold, silver, FOFs essentially are for anyone who doesn't want to use a demat account. But there is one more kind of mutual fund category which holds gold, which is multi-asset funds. Now, multi-asset funds will look at equities, will look at some amount of fixed income, and will also look at gold. And the only specification is that they need to have at least 10% in all three of these categories. So that at a time like this, when equities are coming down a bit and, gold has been going up, have we seen in these multi-asset portfolios the position of gold going up?
Yeah, I think the data suggests that obviously the gold ownership by multi-assets have increased. So for example, if I'm looking at December 2023 ending data, which is almost 15 months back, on an average, multi-asset funds held almost 11.5% of gold via ETFs or ETCD, which sorts of, I think, moved down to almost 10.6, 11% around August, September last year. I think that is when equity markets were at also all-time high. And when the correction started, right, from 10.6% in September, when the correction started, people obviously, as I mentioned, try to invest more in gold as a safe haven asset, and there have been indicators since quite a while that there are multiple factors which are sorts of supporting the gold prices, and those factors continue to remain. So from 10.6%, now we are looking at a holding of almost 13.4% in multi-asset funds. Same sort of increase we are seeing in silver also. So we are seeing that both gold and silver holding in multi-asset funds have increased, and I think that's pretty understandable also, right? You have to invest in these commodities when there are market turmoils, because that is what multi-asset investing is all about. Like Shira showed, that if you mix assets of different profile, you get a lower volatility and better risk-adjusted returns.
Yeah, absolutely. And we get all of the details on the inflows that these categories are seeing, whether it's gold ETFs, whether it's multi-asset funds, and these are the categories where there's been high demand coming through. Sheila, I just want to go back to the central bank buying part once again, because that has, like you mentioned, been one of the key reasons that we've seen this big rally come through in gold as well. I know in February the Indian Central Bank did not add positions, but China continued to add. Is this going to be one of the key factors that, in case this stops, in case, or even if not stops, in case it comes down a bit, should we expect a big kind of impact on gold prices? Is it a risk to gold prices?
So see, the diversification from the US dollar by central banks actually gained momentum when the US impounded, Russian exposure to gold via the treasury bills. Now, after that, we've seen, Trump getting elected last year and announcing a lot of tariffs across various countries. So that is a major factor in how economies behave, and then also try and insulate themselves from the impact that dollar can have on their economy. And I think that would become a major factor in central banks deciding. Price, of course, is one thing, but there are various other factors. So geopolitical events could also contribute to how central banks, move away from the dollar and into gold. We've seen that happen right since COVID, and whether it's RBI or any other central bank, a lot of countries are also getting into bilateral trade arrangements rather than just use a US dollar route. So all of these factors would actually decide, and it's not just price that helps central banks make their decisions, but various other factors that could have an impact on how central banks look at gold and change their reserves from US dollar to gold.
Okay, understood. I think we've covered the length and breadth of gold, but I'm just going to come to you for one final question, or to wrap it up, if you have to say something on, the gold price move that we've seen, and also come in on silver, because there's big demand for that as well.
Yeah.
So any closing thoughts on, how we could see these two asset classes move, and what would you advise?
No, I think first of all, while people are talking about that gold and silver ETF together have AUM of more than around 70,000 crores, it's very minuscule to what the potential of Indians are to invest in gold, right? I have to reread twice that Indian households roughly hold around 25,000 tons of gold, right? That is phenomenal. If
You're
you,
saying, right? We love
yeah, yeah. And RBI itself holds around 870 tons. SGB, when it was launched, I think the total holding was somewhere in north of 140 ton now. Whatever is not redeemed is roughly around 130 ton. ETF a year or so back only held around 55 tons. If I project it should be somewhere around 65, 70 tons or so, Indian ETF. So we have quite a long way to go to sorts of pull Indian investors to this very safe investment vehicle, right? Because, like I mentioned, after SGB, this is the only regulated way and paperless way to invest in gold, perhaps one of the more liquid, safer, purer way to invest in gold, right? So I think rather than focusing on the fact that we have hit 3,000, we hit 2,500, 210 days back, then 2,000, perhaps 1,700 or 1,800 or 2,000 days before that. Instead of talking about levels, we should just talk about the fact that we should all sorts of focus on uh, this new gold investment medium, which you can use as a tactical play to play at gold prices, right? There's nothing wrong in that. You can invest from a long-term point of view. You can do SIPs, STPs, etc. Uh, for silver also, we are pretty bullish. I think it's a gold webinar, so I will not take much time. We have hit 97,000 on silver. I think we are bullish on silver. Probably, if you ask me right now, I'm probably a bit more bullish on silver than on gold. So I wouldn't talk much about that in front of Sheila. But both the asset classes, I think, fits really well in any investor portfolio. Gold is more of a safe haven asset. It has lower correlation with equities. It has uh, performed relatively better when markets have been in turmoil. There are multiple tailwinds which support gold prices right now. Silver, on the other hand, has been more volatile. So you have to be a bit more cautious when you invest in silver. And accordingly, I feel that your proportional investment in silver should be lower while we are bullish. But please consider the volatility which silver has, because while both are precious metals, silver and gold has behaved in a very different manner for a very long period of time. So consider both before taking position in gold or silver.
Silver is like the mid-cap index. No, but Siddharth, do you have any kind of data on what gold ETF holding is like internationally? Because of course in India we love holding physical gold, and it makes up a bulk of the investments. In a developed market like the US, are gold ETFs the primary way in which someone would hold it?
I think Sheila can probably answer that, because what I refer to World Gold Council report when it comes to what is happening globally. From what I know, that after a long time we are seeing a sticky inflows on the gold ETFs in North America and Europe, and that's happening to see. Perhaps Sheila can add on to that.
Yeah, I think globally, people don't buy the amount of jewelry that we do. Indians love physical gold, and till we had access to financial markets, and till financial inclusion through Jan Dhan accounts, or even access to mutual funds, whether through digitalization became the norm. The only way for people to save, even before they had a bank account, was through gold. So, and that was physical gold, therefore it was jewelry which you could wear. Globally, we especially developed markets like Europe and US, it's more bars, coins, or ETFs. So that's the route for them to invest, rather than park money in physical gold, whether is through jewelry. So yeah, I mean, we've seen last year, Western investors didn't really put in so much focus into ETFs, but they are coming back. And likewise with Indian investors who have actually contributed to the ETF demand in India.
Okay, and I'm sure we'll keep seeing that grow. You know, ETFs overall only in the Indian market are just picking up. This is about 10 years later what's happening, even if you look at standard equity ETFs of what's happening in the US. But Sheila, any final closing thoughts that you have on gold, on where you see it headed, or just how optimistic you are on it?
See, gold is an asset class that it's not just a safe haven asset, right? It also ensures your portfolio against various risks that could affect not just systemic risk, but also, global risk. And we've seen from time to time through various analysis that we have, through the insights that we produce, that it's always useful to have some of your investments in gold. For some markets, it's between 5 to 10%. In some markets, it's anywhere between 7 to 15%. But whether it actually reduces volatility, which it does, and also improves risk-adjusted returns, is all backed by facts. And we've also seen central banks, moving away from the dollar to some extent, and allocating money to gold. So that itself proves that gold still has a long way to go, and investors should consider gold when they think of diversification and portfolio allocation.
All right, very helpful chat, Sheila. Siddharth, thank you very much for joining us and taking us through all of these details on, this big rise that we've seen in the gold prices, but also what we could see from here on, and then taking us through how an investor can approach it. So I hope that's been helpful for all of you tuning in, and I hope that has given you some ideas on how you can approach this asset class. Thank you for tuning in.